you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. A Disney analyst is giving a very serious stock warning that it's time to sell Disney stock because even at around $80, it's way too high. I do not do a lot of videos talking about stock prices. Occasionally I will mention it, but in reading this article, they pointed out really clearly why they think that Disney stock at best should be in the 60s. And that's a very big difference from even where it's fallen right now. I very much agree with this guy. I do not like the direction this company is going in. I've been covering Disney a lot, so I'm going to do this one video talking about this serious stock warning for Disney because I do think it is an important story, but of course this is not investment advice. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up. I really appreciate you guys. So Disney stock right now closed at $81.58. That is not the lowest price it's been in 52 weeks, but very recently it was at $79.75 thanks to this terrible dispute with their number 2 cable customer, who actually is very close to their number 1 cable customer. They pretty much both have around 15 million subscribers. Charter is the one they have the dispute with, and Comcast, believe it or not, is the one they have to negotiate the Hulu deal with. But this price really is much too high for Disney because Disney is basically adrift right now. Coming from Seeking Alpha, Disney's continued scuffling around its verticals without real direction signals time to sell. What he's saying here about scuffling around verticals is basically just saying they're following other companies. They have no leadership position. They have no specific strategic direction that anybody can see. So because they're not succeeding as is, and they don't really seem to have any direction, and they seem to be getting tossed around by everybody, particularly Charter, this is not a good management team or company to trust. Coming from Next TV, Charter's Chris Winfrey, as more sports fans move on from Spectrum, our incentive to do a deal with Disney goes down. His point is look, people are not subscribing to the cable bundle to get a hold of ESPN service. This article from Axios points out how much non-fans pay for sports broadcasts. Disney has right now 74 million subscribers for ESPN at $12 per subscriber per month with an estimated $10.6 billion per year. But the bottom line is people are paying for this and many people are not watching it. And to get an idea of the ratio, if the ESPN stations were sold on their own in a separate bundle, it would take between $40 to $50 per month. I've seen it as little as $30, but their estimate here is from New York Times. It's a pretty good source. Around $40 to $50 per month compared to $12 per subscriber. It kind of gives you a sense that a very high percentage of the people who are paying for ESPN as part of the bundle don't even watch the thing. So why should I be paying, if I have a bundle, $12 a month for ESPN when I could get Netflix for $6.99 a month with ads, or get the premium version for a little bit more? The value really isn't there. And that's what Charter has been telling Disney. Disney could work this to their advantage, but they're not communicating with Charter. They're not sitting down and trying to figure out what they're going to do strategically. They're just trying to force this deal on them, and it's not working. So right away, the author points this out. Quote, every organization should tolerate rebels who can tell the emperor he has no clothes. Quoted from Colin Powell. Great point for Disney because someone needs to tell Bob Iger that. Back in 2019, Bob Iger got Business Person of the Year. And this is the main problem with Bob Iger. In just 2019, Bob Iger had Business Person of the Year. They absolutely loved him over a time. The board of directors loved him. The shareholders had no problem with him. He had a lot of successes up around that point. Unfortunately, everyone assumed he could do no wrong. He did a lot of wrong since then, and a lot of the businesses have changed since then, and there really hasn't been a response to it. This author suggests Disney, yes, could be sold to Amazon or Apple, and maybe they will be, maybe they won't be. Very likely they won't be. However, if somebody does buy the company in the current shape that it's in, the author does not see a value beyond $62 per share, which is an absolute terrible price. He sees the value right now of Disney in the 60s, not where it's trading right now. For Amazon or Apple to buy Disney at $62, it would still have to be a premium to whatever the market price currently was. They're not going to get to buy Disney for $62 if the stock price was $65 in the open market. That deal would just never get done, which would mean it couldn't even be sold. Here's the analysis for other companies that Disney's competing with. Netflix at $443. Investor rationale. A pure play, a sector leadership play. So they're the leader in the industry. Easier to understand, a sales and earnings growth scenario. If you buy into it at the probable biggest and best survivor of the streaming wars, you can make the case for $443. Warner Brothers Discovery, $11. Investor rationale, waiting for Malone and Zaslav to figure it out. You have to be patient. Paramount Global at $13. Investor rationale, Shari Redstone, has to keep selling stuff, anything. Don't stop at Simon & Schuster, Shari. Comcast at $44. The investor rationale, somewhat of a less delusional vision about valuation of its asset base. Lionsgate at $8. Investor rationale, high risk tolerance players in the space think its asset intellectual property base is way undervalued. It could be. At $8 a share, it seems like a decent dice roll. Now about Disney, Disney has by far the biggest, most diverse asset base, of course, bringing the dollar for dollar value into entirely different territory to most peers. The others do not have theme parks, cruise lines, vast merchandise businesses, but they do not either have linear networks, cable IP, as well as streamers. They believe that Disney's asset base, diverse, spread over many businesses, is vastly overvalued. Add its huge debt profile, the morass of the current media entertainment business in general, and for the rotten cherry on top of this Sunday, the current writers and actors strike in Houston, we have a problem. So you have what in their view is a very tough case to make for a bullish outlook, meaning thinking the stock would go up, based on the assumption that Disney's businesses as they are now run can continue laying golden eggs. With all peers except Netflix priced so dramatically lower than Disney, you have to find your logic base in the case for price recovery in all or most of its verticals. That's to say that Disney would have to do well in all of the different businesses that they're currently in. And Disney is spread all over the place in different business sectors, from theme parks to merchandising to streaming to the linear channels. All of those are challenged right now. They're having problems in all of their businesses. It's very unlikely that all of those could possibly turn around. Now, this author is also saying he thinks that Disney should be focusing on creating new IP because the existing IP seems to be getting worn out. This is unfortunate that analysts don't really seem to get this yet, that Disney went in and deliberately destroyed their brands and their intellectual property. Yes, with the woke stuff. But I came across an interesting article and I hadn't thought about it this way. And these guys did a great job of pointing it out. Coming from Screen Rant, underrated Pixar movie destroyed the Disney princess forever. Now they took this to mean something positive. I liked Moana. Moana was a princess. Is she a Disney princess? Well, technically yes, but she doesn't fit the normal Disney princess model. They damaged the brand of what a princess was for Disney. The Disney princess brand is worth an absolute fortune, except they've been chipping away at it and damaging it since then. Moana was actually a good movie. I enjoyed Moana. However, the movie they're talking about is Brave. Brave came out in 2010 and was the first Disney princess, even though it came from Pixar, who wasn't really a traditional Disney princess. And supposedly that's supposed to be a great thing. Why? Because it's the story of how bold, determined, quick-witted heroine changed the Disney princess brand forever. Well, that isn't good. That's not what you're supposed to be doing when you have a very powerful money-making brand that no one has anything like in any similar way. Anytime anyone has done anything similar to Disney's classic brands in the past, it's always looked like a cheap knockoff. Now, basically, nobody has the niche, so Disney throws it away. So I don't see how Disney creating new intellectual property when they're damaging and destroying their old intellectual property is going to help anything. Moana is a princess. Did she need to be a princess? No. I mean, it was fine. It was a good movie. And that's absolutely fine. The story made sense. It was good. But what's not fine is Disney destroying what they had that was so valuable to just try to update it and destroy stereotypes. Brands are stereotypes by definition. It's incredible to see. This is why I thought this is such an important article to do, because these guys cover a lot of what's important about what's wrong with Disney from an investment standpoint, and it makes a different side of the case than I usually make. But I don't think this author completely understands brands. That's why you got me. They're calling attention now in this article to the old ranchers adage as the difference between analysis of a sector and operators. Anyone can weigh cattle, not everyone can raise cattle. Disney used to be one of the better raisers of cattle in the business. That is no longer the case. Building a bull scenario on that assumption goes way beyond the piling up of metrics. He's making a great point here. Disney's business really is the intellectual property business. Everything is built on top of that. Do you think that Disney is in touch with what consumers actually want when you compare them to Warner Bros. Discovery's Barbie or Super Mario or the Minions from Universal? Definitely doesn't feel like it to me. The ongoing delusions that support $80 today for Disney's stock price and price targets of over $100 going forward. The performance of Disney films released over the past year appear to confirm the view that they've been aging out. Guardians of the Galaxy broke the mold of failure because it was a really good film at the endgame of the superhero genre. Then you're told that Disney theme parks are so much a part of the childhood of American children that no matter how high prices are raised, parents will cough it up, even at the expense of sometimes more pressing family needs. There is a core truth to this if you assume that the economic laws of price elasticity and inelasticity no longer apply to Disney. But the price hikes at the theme parks have broken through even the powerful parental need to produce memories for their kids. People can't afford it, and inflation is jumping up again, and we're about to see gas prices go up again, which destroys a lot of economic activity. We are being told that the rescue of Disney's streaming business lies in steady tweaking of pricing between ad-free and ad-supported. That's too simple an answer. The hard truth is that the persistence of glut throughout the sector and the habit pattern that the streamers have created just doesn't work. It's a Frankenstein of their own making. In brief, it's produced a subscriber mentality that picks a handful of shows per company, gets either a cheap trial or a low price to entice, and then when the shows are viewed, they jump to other subscriptions and they leave the other subscription service behind. We're being told that Disney's linear networks are under scrutiny for possible sale or spinoff, or the candidates for cost discipline. Does this mean an end to the catering of the massive egos of named performers, producers, and of course dedicated wokeists to be gone? Perhaps, perhaps not. We do not know that far too many famous names behind its old hits have long underperformed their bloated price tags. Disney appears to continue to be overpaying for people for what they were, not for what they could be. And ESPN is the scariest of all because ESPN just keeps shrinking. And at the same time, you've got Charter pushing back and saying, you know what, maybe we don't even want to subscribe to ESPN. If Disney was smart, they'd sit down with the Charter people and they'd say, hey, look, help us figure out how to give you guys what you need, but at the same time, give us what we need. Because Disney seems to not have the management people in place anymore to do things like that. The Charter people can help them figure it out. And they could also do it in a way that makes both of their companies look good. And if they don't do that, it's going to be really, really bad for Disney. It's just shocking to see they haven't done it already. And here's the conclusion. Content is not king. It's king at times, otherwise a pawn in a game where the rules have changed. So far, Disney's management and board have yet to confront the reality that the long, glorious business model and performance of the company is not just a broken business model due to macro factors, meaning things outside their control. Broken implies repairs are possible to make the engine purr again. In their view, extinct is closer to the truth. And mine as well. I think their business is extinct. When an animal or plant goes extinct, it means that it has failed the test of survival when buried by catastrophic change. It's fair to state that the media and entertainment sector has entered something of an ice age. The compounded after effects of COVID on dramatic changes in lifestyle, the untamed burst of runaway inflation, and the sheer buildup of content glut has squeezed the life out of attention spans already shrunk after being assaulted by social media obsessions for too long. Audiences, such as they are more fickle than ever, more harder to please, more just as happy snapping moronic selfies for their kicks than sitting out a long movie. The prescriptions that have come out of Disney since the destruction of the old world of media and entertainment began in 2020 fail to meet the Darwin test. Until there is real change at Disney, Disney is absolutely a sell. It is not a stock anybody should really be holding on to. A lot of their business models are extinct. That is why they are failing in all those businesses. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.